Okay, as we march towards the opening bells to see how the stock story plays out on Wall Street and Bay Street today, let's take another look at what's happening with Canada's currency. The loonie right now slightly higher against the American dollar, but we have seen a steady slide in the loonie. We're obviously monitoring all the headlines on interest rate policy and the economic picture in Canada versus the U.S. Our next guest would not be surprised to see the loonie weaken to below 70 cents U.S. heading into next year. Karl Schamotta joining us here in studio. He's chief market strategist at Corpay. Karl, nice to see you.
You as well.
First off, why have we seen the Canadian dollar weakening against the American currency?
I think there's been a profound divergence in economic data coming out of the U.S. and Canada. Firstly, you have the U.S. steaming ahead, much stronger growth than expected, wage inflation pressures still remaining, prices still continuing to rise, excess demand still there, consumers continuing to spend, businesses continuing to invest. All of that stuff has been lifting the U.S. dollar on a secular level against everything in the world. But at the same time, we've seen the Canadian economy exhibiting clear signs of a slowdown, right? Everything from, when you look at the fundamental level of activity to consumer spending, to residential investment, to business investment, to the Bank of Canada's survey data, all of that's pointing toward a situation in which the Bank of Canada not only has to cut as aggressively as the Fed, but potentially has to cut even more aggressively than what is currently priced in.
Okay, because sometimes we'll hear about currencies being selected because of their safety or the U.S. dollar, but it sounds like you're talking about if the economy is strong enough that you can have higher interest rates, or this idea of higher for longer interest rates.
Yes.
That plays into a currency's strength. And if in the Canadian economy's case, we're seeing weakening and possibly the likelihood of rate cuts,
yes,
that weakens the currency. It's like a 1-2 punch kind of thing.
It is a 1-2 punch, and the reality is that it's fundamentally about balance sheets, right? It's the fact that the private sector in the U.S. is carrying vastly lower debt levels than the Canadian private sector. That means that when we see global borrowing costs rise, as they have for the last couple of months, we know that the pain is going to impact Canada in a more profound way. And so that divergence is fundamentally, I think, what currency traders are playing. What's amazing is the extent to which oil has not factored into it at all. We've seen correlations plummet between oil prices and the Canadian dollar, and much more focus on what is happening from a macro perspective in the economy than what we had seen for years, I think, in the Canadian dollar price action every day.
Yeah, it's a notable point. You've talked to us in the past about some of those correlations with oil in past instances. With the economy story here, given the interest rate environment, the difference in duration of mortgages, I know we talk about it all the time, but we're built around a 5-year mortgage market. The U.S., they've got those 30 years. Do you think that's playing a role in terms of the strength of the economies, the comparable?
No question.
Okay.
However, the funny thing is that I think I got something very materially wrong late last year in thinking that the cliff was coming much quicker than it was. The numbers that the Bank of Canada has released in the last year really suggest that over the next 5 years, that burden on Canadian households continues to increase. So as Canadians go to refinance, as variables are rolled out, as new mortgages are taken on, all of those borrowing costs go up and up and up. And it's like a 5-year kind of continued gradual incline, which means that if you're a currency trader and you're looking at the long-term picture for the Canadian economy, you kind of have to assume that consumption and business investment is going to remain relatively low for not just a year, not just 2 years, but potentially 5 or more years into the future.
Yeah.
That's front-loading it on the Canadian economy relative to what's happening in the U.S., where, firstly, households had deleveraged a lot, and secondly, they're termed out in a much more favorable way than here in Canada.
And look, what you hear is Canadians want to make sure that they pay their mortgages. They're pretty good about doing that. But to your point, we're entering this sort of murky stretch here where just a larger swath of people might feel the pain. I heard from somebody yesterday, too, just you're not seeing enough new development of residential properties because they generally rely on a big group of people to commit to buying, including
Yes.
investors. And because of the rate environment, that they've been a little bit more cautious. So it slows everything down, and then it gets back into this affordability nonsense that we're constantly talking about. But that's a story for another day.
Yeah.
Well, you want to get into that.
One thing I would mention there, though, is that like what we're looking at is sort of a fundamentally Japanese situation, right? Like back in the 90s, what happened to the Japanese economy was that property prices essentially plateaued. They didn't necessarily crash, right? But the whole economy refocused from property investment and from the types of activities it was doing through the 80s towards something more sustainable and more export focused. And that's basically what we would expect to see happen here in Canada.
Yeah. Although it'll be interesting to see as soon as there's a signal from the Bank of Canada of a change in rate policy, what happens to that housing market, which generally bounces back a lot. Okay, so you think we could see weakening in the Canadian dollar heading into next year? I mentioned possibly below 70 cents. Is that what you think could happen?
Yeah, I think short term, we do think that the U.S. dollar is a little overbought, so we could see a modest bounce. But longer term, we are in a situation where markets are currently anticipating the Bank of Canada cutting less aggressively and less profoundly than the Fed. And that just does not line up with history, and it doesn't line up with the current economic situation in Canada. So what we do think is that those rate expectations are going to come back down more profoundly. Interest rate differentials will tilt more decisively against the Canadian dollar, and that should drag us down another couple of cents from where we are today.
Okay, interesting. That kind of counters what we were hearing from one of our guests on the street earlier this morning. But watch that trend. Before I let you go, we talked with Dennis Lockhart, formerly of the Atlanta Fed, before the break. He's very closely watching some of those funding efforts by the U.S. government, which is this other dynamic in the bond market. And you have seen the latest news this morning as more important possibly to the market today than the Fed decision this afternoon.
Oh, I definitely think so. So this morning, the Treasury essentially said that they're not increasing the duration of their portfolio as much as had been anticipated, which means that markets have to absorb less long-term money, more short-term money. That is putting downward pressure on yields and helping to stem some of that sell-off that we had seen that pushed term premia up, pushed the 10-year up so decisively in the last couple of months. And that's giving relief to global markets. It's kind of interesting to see what's happening in currencies. Like the Canadian dollar is supported by this, but the U.S. dollar is remaining relatively stable. So, yeah, big picture here, though, is that one of the biggest reasons for that big run up in yields has sort of moved to the sidelines for now and is likely to be well understood for the next quarter as well.
Okay.
So what we have to watch is what Dennis was talking about, and that was, are investors worried about the fiscal path, the fiscal trajectory of the United States or not? We just don't know at this point. We can't separate anecdote from fact, and we just don't know what this is going to break down into in the next couple of weeks. If yields continue to rise, then we are clearly looking at a shift in market perception around the U.S. Fiscal trajectory in the long run.